Today we want to continue to talk about residential financing. We want to start with slide number 38. So on this slide we have a chart with the title Creating Two Assets. So typically for a residential mortgage, we start with the application for the mortgage. This would be the time that the potential home buyer, before or during the process of identifying a property that the household wanted to purchase, and it's going to submit a mortgage application to one particular bank. And this bank is going to go through the so-called underwriting process to figure out that whether the home buyer is creditworthy to have the mortgage. So this loan application is going to lead to a decision about whether the bank wanted to commit in terms of making this particular lending. That would be the so-called loan commitment. Loan commitment on this particular time and date. The bank will notify the mortgage applicant that, oh yes, we approve this particular loan, and at this particular time, the level of the mortgage rate, the interest rate, will be disclosed and notified to the mortgage applicant. And so this is the day that the potential home buyer will know about what kind of mortgage rate that they will need to pay when they have this particular loan. And in general, there is 1 to 2 months of the time period by which that the home buyer and the home seller will need to prepare for this particular transaction. It's not like buying a home is not like buying a stock. Buying stock, when you submit a buy order, you can have the transaction done like within 15 seconds. But when you buy a home, often the case that it comes with a long list of contingency. For example, if today you go to take a look at a home, you say that I like this home, but maybe the interior is kind of old, and maybe you request to the existing homeowner that I want to buy this home, but conditioned upon that the paint of the entire home need to be new. Okay, and of course, if this is the case, then the existing homeowners say that, okay, this is a reasonable request. The existing homeowner will need to bring in people, worker, and then to have the entire house repainted. It would take some days. It's not like when we talk about selling this house, we can do that right away. Often the case that it takes several weeks to prepare the home, and for this purchase, not just from the seller's perspective, sometimes even from the buyer perspective, because buyer need to come out with all of the necessary financing and prepare for this particular transaction, etc. And so usually we're talking about 30 to 60 days between the loan commitment and the closing. Okay, on the day of a closing, the loan will be provided such that the home buyer would be able to actually purchase this home. That would be the closing date. On this particular closing day, we start to have the so-called the creation of the two different assets. The first asset is the loan itself. Okay, but loan is only involving the money payment, the cash flow payment from the new owner of the property, and to those investors that provide this particular lending. On top of this, there's a second asset, we call that servicing. The servicing asset involving the right to collect monthly payment and then remit to investor, and also, for example, manage the late payment, default, foreclosure, etc. And usually this service right will be initially owned by the lending bank. Okay, but this particular initial lending bank may sell this service right to a different financial institution down the road, if so desired. So here we're talking about a separation of the two assets, in the sense that the loan itself is one asset, but the right to service this particular loan is another asset. And for the lending bank, often the case that they will retain their service right, at least in the near future, but they will quickly sell the loan to someone else. And who would be those potential buyer of the loan from the bank? Okay, in this loan disposition phase, that the bank would need to think about two possibilities. One, sell this loan to someone else, like Fannie, Freddie, or the whole buyer, okay, like Goldman Sachs, Morgan Stanley, those, or insurance company, etc. There are many financial institutions out there that stand by to buy a pool of the mortgage from those banks. Another possibility is for the bank itself to securitize those loans and then to sell that to an investor. Those end investor of the mortgage-backed security, typically they can be institutional investor globally, and global institutional investor. It could be small investor like Kevin Chen, okay? Because through the securitization, we kind of break down a large sum of the mortgage into a small denomination of the security, and such that it's easy for even small investor like Kevin Chen to invest in those mortgage-backed security. Okay, so that would be the so-called loan disposition decision that the bank would need to make. And from this date, from the loan disposition to the day of the loan commitment, in this chart, it has shown you that usually it would about 2 to 3 weeks, 2 to 3 months, 60 to 90 days. And it is this time period we have the so-called pipeline risk. Okay, pipeline risk is a risk for the lending bank between loan commitment and the loan disposition. And there are two different types of the pipeline risk. The first type of pipeline risk is a so-called fallout risk. What does it mean by fallout risk? Okay, consider that you wanted to buy a home. You apply for a mortgage. And then on one particular day that your bank said that, oh, we are going to commit to this loan, and your mortgage rate would be, say, 4%. Okay? And you say that, oh, 4% seems to be reasonable. Okay, and I wanted to go through this, the next 30 to 60 days time period until the day that I close this particular property. But there's a possibility that in the coming 30 to 60 days, the market interest rate drops substantially, such that if you apply a new loan to another bank, you might get 3% interest rate instead of 4% interest rate. And because this is just a commitment, it's not from the bank. It's not like that you, as a consumer, you have to lock into this particular loan. So you have this option, you have this right. When the market interest rate drops substantially in the next 30 to 60 days between the loan commitment and closing of the loan, you can simply say that I don't want to go through this particular loan commitment. I shop with another bank and get a 3% interest rate instead of 4% interest rate. So this is the so-called fallout risk from initial bank's perspective, that initially they committed 4%, but just that the market interest rate drop in the next few weeks such that I lost this business opportunity. So whenever there is a market downturn on the interest rate, that a lot of banks won't be able to actually make the loan at a relatively high interest rate. But the opposite situation would be that, let's assume that a bank commit at the interest rate of 4%, and in the following 30 to 60 days, the market interest rate goes up, say from 4% to 5%. Then what happened to those loan applicants that initially have this commitment? Of course, they want to grab this 4%, because if they go to a different bank in the later date, the market interest rate, the mortgage would be much higher. They are not going to do that. They would love to have this commitment. In other words, here we're talking about a selection process. There's a self-selection. Okay, when a bank made a commitment, the bank understand that. Okay, they are at a disadvantaged position because there is an option, there is a right from the loan applicant's perspective in terms of whether they actually want to go through this commitment, depending on whether the market interest rate in the future goes down or goes up. Okay, so this is the first type of risk that from lender's perspective during this pipeline period. Okay, another risk is a so-called interest rate risk, and we know that this is a loan, it's a fixed income security. When the market interest rate drop, what happened to the value of a loan? The value of loans goes up. And vice versa, when the market interest rate goes up, what happened to the value of the loan? The value of the loan is going to drop. Okay, so it is this later scenario that the value of this particular loan will drop before. When you create a loan with a high value, and then later when you sell that at a low value, then the bank is going to lose money. Okay, so this is the second type of the risk that the lender will need to bear when they make this kind of loan commitment. Okay, and this kind of interest rate risk, okay, will last from the day that you make the commitment to the day that you actually sell your loan. So it's the 60 to 90 days period between loan commitment and the loan disposition. During this time period, we have the so-called interest rate risk. And the fallout risk is going to occur between the day of a loan commitment and the closing. That will be a time period of 30 to 60 days. Okay? So, next slide. The next slide, specifically talk about pipeline risk. And we have these two different types of pipeline risk, including fallout risk, including interest rate risk. And because mortgage bankers are highly leveraged, okay, when they make the loan, and they are particularly sensitive to this kind of risk. And banks in general do not like to bear unnecessary risk. Therefore, often the case that they would hedge away this kind of risk. And the government agency, like Fannie and Freddie, they are also active provider of this kind of interest rate hedging service. And those banks would be able to purchase the forward commitment, okay, from the Fannie and Freddie, and to pass on this kind of risk to Fannie and Freddie. So this is another type of service that the Fannie and Freddie has been providing to the mortgage market in terms of providing risk management solution. Next slide. And Fannie and Freddie play a very important role in the so-called secondary market. Okay, the primary market is where that the lender, local lender, make the mortgage to home buyer, and those mortgage lender, okay, eventually, most of them eventually sell those mortgage to the secondary player, and Fannie and Freddie are the most important player today. And Fannie and Ginnie Mae, they were created in 1968, and these two entities are active players in FHA and VA loan. So those government-sponsored loans are handled by Fannie and Ginnie. And Ginnie is working on securitization, and Freddie is now working on the government-sponsored mortgage. And Freddie created in the 1970s, so it's 2 years after Fannie and Ginnie were created. And Freddie were taking care of the so-called the conventional loan. That would be mostly on the conforming loan. for the non-government sponsored type of mortgage. So Freddie is very active for the typical kind of the mortgage in the secondary market. Next slide. And mortgage-backed security are very important instrument in the residential mortgage market. Individual mortgage, okay, like for example, I have a mortgage, okay, and the size of mortgage initially was like almost $400,000. That's a lot of money. You don't find individual investor would be able to invest in a contract that is size of $400,000 easily. You don't do that. So the idea is that you divide this relatively lump sum amount of the cash flow into much smaller security, such that each security maybe have a size of like $40,000, okay, or $4,000. And by having a denomination, the contract size to be much smaller, now you have liquidity. So mortgage-backed security, MBS, is based on the idea that we standardize a lot of mortgage, and then we divide them, each one in a relatively small size, such that we can sell those individual mortgage-backed security, not just within the United States, we can sell them globally to small investor in China, small investor in Japan, or the institutional investor in Brazil, etc. By doing so, we basically open up all of those possible lenders to invest in this particular market when we have a relatively large amount of the supply of capital. We'll be able to do this mortgage lending at a lower interest rate. And that's the reason why the mortgage interest rate, when we look at historical perspective, the spread from the mortgage to, for example, 10-year T-note yield have been consistently coming down over the past 100 years. And it really making the home buying in the United States much affordable, relatively speaking. Okay. And the creation of the mortgage-backed security, okay, is to usually lump many mortgage loans into one pool. Based on this pool of mortgage, that we issue a large number of mortgage-backed security, and then this mortgage-backed security are the so-called pass-through security, and that entitle investor to pro rata shares of all the cash flow. And the mortgage loan in one particular pool that we create those mortgage-backed security, those mortgage, okay, those they tend to be quite similar among themselves. They tend to be a conventional loan. They tend to have the same vintage. That means that they will issue pretty much around the same time point, and they have a similar interest rate. This facilitates the research and the pricing of a mortgage-backed security when those underlying mortgages are similar. Okay, that makes the analysis those work much easier. And today, roughly about 2/3 of all of the home mortgage in the United States, they will eventually be securitized. So the majority of a home loan, okay, are not owned by the initial underwriting banks. They will be sold to Fannie and Freddie, or been sold to Goldman Sachs, Morgan Stanley, and then Fannie, Freddie, Goldman Sachs, and securitize those home mortgage and sell those mortgage-backed security to investors globally. And 2/3 of them went through this route. Okay, so this is a default method of the commercial residential financing for mortgage. And mortgage-backed security, in terms of the sponsor, could be the government agency like Fannie and Freddie. Fannie and Freddie are very active for a conventional residential loan. But at the same time, we have the private label mortgage-backed security as well that are being securitized by private firm like Goldman Sachs or Morgan Stanley instead of a government agency. So in the future, if you hear about one term say that this is an agency mortgage-backed security, then it means that it is residential mortgage, and they are for sure a conventional loan underwritten by Fannie or Freddie. Okay, next slide. Agency mortgage-backed security, we have Fannie, Freddie, Ginnie working in this particular domain. And this kind of mortgage-backed security has a very unique feature in the sense that this kind of mortgage-backed security underwritten by government agency has no default risk. Let me say this again. The default risk have been absorbed by those agencies. Agencies have ensured mortgage-backed security investors that they will not suffer any default risk. And in other words, that if one of the mortgage in the pool of this mortgage-backed security default, then those government agencies, Fannie, Freddie, is going to make up that damage. So they provide the insurance to the default. So that kind of simplifies the pricing, making this kind of agency mortgage-backed security particularly safe. Okay, and they are almost like a AAA security because with the government guarantee that there will be no default. And of course, when the government agency provide this kind of insurance to prevent to absorb all of the default, they will need to charge a premium. It's very much like if the insurance have been provided, then someone needs to pay for that insurance premium. So one of the revenue for the mortgage-backed for the agency like Fannie Freddie, it will be the premium that they collect after making this kind of the guarantee to absorb default risk. And next slide. So we have in this slide we have exhibit 12.6. In this chart it demonstrates that when Ginnie Mae underwritten and providing the guarantee for default risk, how this thing works. So initially in this chart, we have a lot of banks. Okay, like TD Bank, we have many banks out there. They do the underwriting for those residential mortgage. Let's assume that there are many loans out there. Their interest rate is roughly about 7.5%. Okay, the 7.5% mortgage rate. And then there are many mortgages. Maybe one of the mortgage is Kevin Chen's mortgage. You can think of that. And then you get into this fixed rate pool, going through the FHA, VA, this entire pool together. And then they create many of the mortgage-backed security. But here you may notice that the interest rate for those resulting mortgage-backed security only have interest rate of 7%. So there's difference between that 7.5% and 7%. The difference of 0.5% is a premium. And the reason is that it has a guarantee being provided whenever there is a default from one of those mortgage. The Fannie is going, the Ginnie is going to pick up that loss, and in return they charge the 0.5 interest rate. Okay, such that the end investor, for example, investor in China, when they purchase this particular mortgage-backed security, they can only earn 7% rate of return, and that 0.5 return difference would be the revenue to Ginnie, and they use that 0.5% interest rate to make up any kind of default loss in the future. So this is how it works for the securitization. Next slide. So here we have the growth of the securitization of the home mortgage starting in the 1980, and only about 10% of the home loan have been securitized. And as time goes by, as you can see that by the beginning of this century, that the market share of securitization has been about 55%, around the 55%, and today it's about 2/3, about 66%. Okay, so we see this market is very, very large. Next slide. And there are two different types of the mortgage-based kind of security, and one is the so-called collateralized mortgage obligation, CMO. CMO is one type of mortgage-backed security, but the difference for CMO with the traditional agency mortgage-backed security is that the CMO had changes. This means that those resulting mortgage-backed security, they have many classes. Some classes has higher priority for the claim of the cash flow than the other. So we might have change A, change B, change C, and change D, etc. And only after change A get all of the money, then change B start to get the money. Only all of change B investor receive the money they deserve, then if there's any residual money, will go to change C, etc. So it's like a waterfall kind of priority. When the resulting mortgage-backed security have this kind of change structure, we call that CMO. And CMO, if you look at those underlying mortgage, many of those underlying mortgage are the so-called subprime mortgage. Subprime mortgage are a mortgage that have been lent to those home buyer that have a lower credit score, for example. In other words, that those are the more risky loan. When you have a more risky loan, when you create, if you have a homogeneous mortgage-backed security, and sometimes it's hard for you to sell those mortgage-backed security because the quality is not good. Once you have a change, then the change A is going to be very high quality, almost like a AAA. And then you have a change B, still pretty good, and change C is kind of not that great. And then change D is really terrible in terms of the quality. And in general, change A and change B are easier to sell, okay, because they are relatively safe, so they have a good market. On the other hand, something like a change D, because quality is very poor, has a very high amount of default risk, and therefore usually it will be retained by the mortgage underwriting bank, like Goldman Sachs. When they create something like a CMO, they will need to retain quite a lot of those change D on their book. And Lehman Brothers fell in 2009. And one of the main reasons was that the Lehman Brothers was particularly active doing CMO way back those days. And they sell those change A, change B, earn a lot of fee. They were really happy when the time was good. But once entering the financial crisis, because they have a lot of change D on their book, therefore those change D, the valuation dropped quite a lot and not being able to get necessary financing, so the bank kaboom. Okay, so that's a CMO. And there's another type of the mortgage-based kind of security. It's called CDO, and CDO is the collateralized debt obligation. CDO, and CDO is even more horrific than CMO. I just mentioned that in the CMO, right? Change A, change B, those are high quality stuff. You can sell them relatively easily. And change D is very difficult to sell. So after some investment bank have too much of change D, so they say that now they may get a bunch of the change D, put them all together, create additional change from the A, B, C, based on all of those change D from those CMOs. So we're talking about rebundling of the low quality change D of the CMO. And that's what we refer to CDO. So CDO is even more terrible. And so those are the kind of securitization product that are available in the market. Next slide. Now let's talk about underwriting decision in the residential mortgage. Underwriting here refers that our local bank, what kind of process that those loan officer, in our local bank, what kind of thing that they will need to look into before they decide whether they want to make a loan to you to buy a home. And this process we call the underwriting. There are 3 C in this underwriting process. In other words, that those local loan officer will pay attention to these 3 criteria before they make a decision about whether they want to commit a loan. One is collateral. Collateral means that the value of the property. And this value, of course, that we learn is going to be established through an appraisal report. And the second C is creditworthiness. That means that how credible you are as an investor, as a home buyer. And they will usually look into your credit report and your credit score. Okay. And then the third C is capacity. Capacity means that given your monthly income, they will determine that there's a maximum amount of money that you can borrow. And that's the capacity. So we have 3 C, collateral, creditworthiness, and capacity. Next slide. Okay. In terms of capacity, and they will compute a capacity ratio. And there are 2 ratios have been widely used. The first one is the so-called housing expense ratio. That is PITI divided by GMI. PITI refers to principal, interest, property tax, and insurance. And here we're talking about the monthly payment. So it's a monthly share of the principal and interest. That would be the monthly check that you need to mail. And also the property tax and insurance per month, divided by gross monthly income. And usually the underwriting standard is try to make sure that this ratio does not exceed 28%. In other words, they will not lend you the money so much that this fraction exceeds 28%. And that basically imposes the amount of the loan that you'll be able to get. The next ratio that they use quite a lot is the so-called total debt ratio. And here is PITI plus LTO, then divided by GMI. So the only difference here is that the numerator, okay, also include LTO. LTO is long-term obligation, like the monthly payment to child support, and leasing obligation, like if you lease a car, okay, etc. Those would be added in there. And here the underwriting column usually would be set at 36%. And the 28% and 36% for these 2 ratios, these 2 numbers, does change as time goes by. Depends on how much of the risk that the bank want to bear. Usually when the market is good, the bank tend to be more willing to lend, and therefore those numbers will be set at a higher level today. Because we have this pandemics, we have a lot of risk in our system. So today, if you go to see a banker want to apply for a loan, then the number they use for today's lending would be slightly lower than, say, 3 months ago. Just because the risk is not that kind of a fun thing for them to bear today. And in terms of the credit score, and the FICO score, okay, the next slide. The FICO score, okay, is the most important thing for the lending. And the perfect score is 850. And most people don't have 850. If you have a FICO score of 720 or above, then you're pretty darn good. Then you'll be able to enjoy the best mortgage rate. You don't need to pay extra mortgage rate. On the other hand, if your credit score is beneath, say, 720, then your mortgage rate will be slightly higher, okay, to reflect that you are not that you do not have a good credit, okay. For those people whose FICO score is 600 60 and below, then they have difficulty to obtain the so-called conventional loan. They will need to, they will be viewed as a high risk, and often the case that they can only obtain the so-called subprime loan. And the subprime loan is going to have a much higher interest rate. And the subprime lending, the next slide. Okay. And usually we're talking about that either they don't have income documentation, or they have a weak credit, like a low FICO score, and also they don't have enough of the down payment. Okay, they will need to borrow far more than 80% of the home value of the loan. Sometimes they would need, say, for example, 100%. Okay, and or 90% or 95% of the loan to buy the, and they have so little of the down payment. And so this the kind of the lending that often the case that has a high default risk because they don't have whole lot of equity. So it's easier for them to walk away and losing those relatively small amount of equity, and at the same time because they do not have they usually is less well off financially. So often the case that whenever economically we have a shock, and this would be the kind of home buyer that tend not be able to keep their job, therefore lead to default of their mortgage. Next slide. And in terms of the congressional support for subprime lending, and it has been done over the past 20, 30 years. And before in 1992, Fannie and Freddie, okay, they were not in the business of making subprime lending at all. Traditionally, they're dealing with high quality, conventional mortgage. But starting in 1992, the Congress decided that they want to see a higher home ownership. And in order to have a higher home ownership for the United States, and therefore they want to make sure that those people who are less well off financially would be able to buy a home without putting into a whole lot of equity, and still be able to get the mortgage. So they kind of push the Fannie and Freddie into this domain. And Fannie and Freddie that at that time was resisting for this kind of change. They would not want to take on this kind of unnecessary risk. But it's a government agency. When the Congress said that you have to do so, when they come out with the law, Fannie and Freddie had to give in. At the beginning, this quota is about 30%. I mean that they will need to buy, they will need to provide financing to at least 30% of this kind of affordable housing related kind of mortgage. And later that number had been raised to 50% when Clinton was the president, and then further being raised to 55% when George W. Bush was the president in 2007. So it really doesn't matter which which party we're talking about here. They're all pretty much doing the same thing in terms of putting toward the direction that maybe some of the people who should not have the mortgage at the first place that they got the mortgage, and that is kind of a reason that we got into the 2008 financial crisis. Next slide. And we have this empirical evidence coming from this particular article looking to congressional politics and policy. What they have found is that there's the mortgage industry, particularly in the subprime segment of the mortgage industry, that they lobby very, very hard. Particularly, they spend a lot of money on those congressional districts where that including a large fraction of subprime borrower. In other words, that those congressional districts where the economic condition is not that great, and those congressmen that they tend to get a lot of funding from the subprime mortgage industry, and as a result of that, they put a lot of pressure onto Fannie and Freddie and passing the law to ensure that enough of the government funding and services from Fannie and Freddie will go to the subprime or a lower quality kind of mortgage underwriting. Okay, so we have this empirical evidence. And this is the end of this setup slide. And next time when we come back, let's talk about commercial financing. We just finished our discussion on residential financing. See you next time.